We all know the dream. You swipe a piece of plastic and somehow end up sipping champagne in a lie-flat seat over the Atlantic. Free flights, seamless upgrades, and cash back flowing straight into your checking account. But those perks are paid for by a specific engine. When you swipe, merchants pay an interchange fee, averaging 1.8% of the purchase price. This chart shows where that money goes. 86% funds rewards programs. To balance the books, the ecosystem claws that value back through compounding residual interest, quiet point devaluations, and merchant surcharges passed right back to you. It is a closed loop. The wealth required to fund luxury travel and cashback bonuses is transferred straight from users who want easy, low-friction financing to users willing to navigate a highly complex set of rules. To extract actual positive value from this system, we have to look closely at the math. We need to isolate the exact inputs required to come out ahead, whether you are the consumer swiping the card or the business owner absorbing the fee. The ecosystem operates on a single governing rule. Choose the path of least resistance with your finances, and you are mathematically the payload funding the system. Do the math, and you might actually beat it. For the consumer, the first major mathematical test comes when it is time to redeem those accumulated points. Banks offer a frictionless option, their proprietary travel portals. They heavily incentivize these platforms, offering extra points and statement credits to keep your spending locked inside an ecosystem they control entirely. But that convenience is heavily taxed. Book through a portal, and the bank strictly caps the value of your points, typically locking you into a fixed rate of just 1 to 1.5 cents per point. The alternative is pushing your points outside the bank's wall, transferring them directly to an airline or hotel loyalty partner. This comparison matrix shows a $2,400 business class flight to Paris. In a travel portal, locking in a flat 1.25 cents per point requires 192,000 points to book that seat. Transferring points directly to the airline's loyalty program secures the exact same seat for just 88,000 points. There are rare exceptions. If a flight drops below $200 or if you need a non-chain boutique hotel, the portal math briefly tips in your favor. But 99% of the time, convenience destroys your valuation. Bypassing the portal takes effort, but transferring points is the only mathematical route to an outsized return. For the everyday user, the math gets significantly more dangerous the moment a statement arrives. Paying most of your bill feels financially responsible, but it triggers an aggressive penalty. Credit cards offer an interest-free grace period, usually around 21 days from your statement to your due date. Leave even a fraction of your balance unpaid, and that protective grace period evaporates completely. This chart maps out what happens next. You make a payment on the 13th, bringing the visual balance down. But because you didn't pay in full, you get hit with residual interest. A hidden charge begins accruing every single day. The bank divides your annual percentage rate by 365 to create the daily periodic rate, compounding quietly until it appears on your next statement. At 18 or 20% APR, this trailing interest mathematically neutralizes any rewards you earned. You are paying more in daily debt servicing than you are earning in points or cash back. This creates a secondary trap. Residual interest steadily inflates your balance, which directly increases your debt-to-income ratio. A creeping DTI silently damages your broader borrowing power, penalizing your ability to secure a favorable rate on a mortgage or auto loan. If a statement balance is not reduced to absolute zero, the card ceases to be a tool for financial leverage. It becomes a liability designed to drain your cash. On the other side of the register, a small business owner is absorbing the 1.5 to 4% interchange fees that make the consumer's rewards possible. To defend their profit margins, businesses often attempt to pass that exact processing cost back to the customer by implementing a credit card surcharge. This map shows why that strategy is an absolute legal minefield. Connecticut and Massachusetts have complete bans marked in red. Yellow states enforce strict caps. Blue states demand aggressive pricing disclosures. If you operate in a capped state, the math actively works against you. Colorado limits surcharges to 2%. If your merchant processing fee is 3%, you legally eat the difference. In disclosure-heavy states, the friction is operational. Mandates for dual pricing displays and strict avoidability rules create massive checkout bottlenecks, drawing heavy government scrutiny and the threat of fines. If floating expenses on rewards cards becomes too expensive, businesses can pivot to a structural alternative, establishing a dedicated revolving credit facility. A revolving facility operates like an ongoing line of credit. You draw funds up to a limit to bridge gaps in cash flow, and you only pay interest on the exact amount you use, leaving your working capital intact. The trade-off is strict. These facilities often require specific collateral, and relying on short-term credit lines can easily mask long-term operational deficits if revenue drops. Businesses have to choose their friction. You either navigate complex legal surcharge caps to protect your transaction margins, or you secure structured credit facilities to separate your cash flow from the rewards ecosystem entirely. We know how the ecosystem captures value. The question is, when does the effort required to optimize actually yield a financial outcome? This grid maps effort and impact. Travel portals, partial balances, and ignoring your DTI ratio plot in the bottom half. Low friction, but high negative impact. Transferring points, paying balances to zero, and structuring business credit plot in the top right, delivering massive positive returns. The rule is inflexible. If you carry a balance, abandon rewards immediately to protect your debt-to-income ratio. If you pay in full, bypass the portal and endure the friction of partner transfers. The credit card ecosystem is designed to tax convenience. True financial leverage belongs exclusively to those willing to do the math and endure the friction.